Hello, everyone. Good afternoon, everyone. My name is Salim Ali and I'm from San Antonio. I would like to welcome you all to this brief, about half an hour seminar, and want to thank you and Seguin Public Library for providing us with this opportunity to get together. I would also like to personally thank Ms. Mara Benitez for her hard work and for all her efforts in putting this together for us and arranging this community financial literacy event for the city of Seguin and its community. Mara, thank you. Just a little bit about my background. I have been self-employed and independent business owner for over 20 years now. Started as a financial planner, a security stock broker with the Series 63 and 7, and an insurance agent, broker dealing in all aspects of insurance, like commercial, personal, life and health insurance services. I'm still an active Texas licensed life and health insurance agent. I'm also a member and speaker for SOFA, Society of Financial Awareness. SOFA is a 501c3, a nonprofit public benefit corporation. The month of September is a Life Insurance Awareness Month, a time of the year where we focus our attention on the needs for life insurance. Life insurance isn't just for newlyweds or homeowners. It is also important for those who are retired or are planning for retirement. In fact, it's for most of us or all of us. Life insurance can help with financial expenses, estate planning, long-term care planning, and so much more. Technically, life insurance can be an investment of pennies for the dollars. Again, we would like to welcome you to today's workshop. Thanks for joining us. I hope today is to provide you with some valuable information and enjoy this next hour or hour and a half. The topic today we're going to talk is the power of life insurance. There's my information right there, my number, and you can always call me. It's a free consultation. I'll be glad to talk with you anytime. The question is, what is life insurance? Insurance is a transfer of risk between a policyholder and the insurance company. It is a contract between you and the company to pay at a specified time in exchange for your payment of premium. For you, it can also be a multi-purpose financial planning tool, primarily designed to protect family financial security after you die, and secondarily, designed to help protect your financial security while you are still alive. Let's look at why or uncover why people currently have or why they need life insurance. Normally, it falls under one of these four reasons. People want to create a legacy, and they want to live that legacy for their kids, grandkids. They want to cover their final expenses and burial cost. Income replacement for those who are dependent on their current income. What would happen to my family if I were to die? Or, who would pay the rent? Who would pay the mortgage payment? And it can also cover the outstanding debts, because you don't want your spouse to be paying for something you did. Okay. Now, we talked about what life insurance can do for you when you die. Life insurance can be an important step in safeguarding your overall financial plan. You may have already considered purchasing term life insurance, or you may already have insurance through another source like group insurance. But have you considered all the ways your family relies on you and how term life insurance can help bring some peace of mind to both you and those you would leave behind? If anyone would be affected financially by your debt for any reason, including final expenses, hospital bill, or mortgage, student loan, or credit card debt, a life insurance policy can help cover those type of expenses. When you die, life insurance can also help you with pay off your debts and taxes, allow your family to maintain their standard of living, support your dependent goals and dreams, provide immediate access to cash. Everybody asks this question, how much insurance do I need? Well, it's something that you have to decide. It's your decision. It depends on your goals, what you want the insurance to do for you. Be sure the amount you select ultimately does what you plan for it to do. One rule of thumb says 5 to 7 times, and I've heard as much as 11 to 10 to 12 times too. Your usual gross income. Some people just want enough to worry themselves. Others want to leave a significant amount of their his to charity or to their dependents or charities. Now, that's when you retire. Now, how does life insurance really support you or help you during your lifetime? Let's look at that. It can supplement your retirement. It can serve as a funding vehicle for college, education, starting a new business, or funding a business, buying a second home, or even your first home. Your policy features of advanced loan out of the debt benefit can be used for almost any purpose that you can think of. Along with those above benefits, the other best way to get an understanding of the amazing features some of the life insurance policies may have is called living benefits. And let's look at the breakdown of what it is. It's a great benefit. Not all policies have it, but some do, and it's great to have it. The living benefits, what it does for you. What few people know is that life insurance can also help you during the life's most difficult and challenging times. It can help you if you have a chronic illness, a critical illness, or terminal illness. This help comes in the form of associated death benefit riders, also known as living benefits. The living benefits rider help provide peace of mind at a time when the last thing you need to worry about is money. It allows the policy owner to have access to an early payout of your death benefit within your policy if the insured is diagnosed with the qualifying illness or injury. Let's look what those are. Chronic illness, it pays you a month should you become diagnosed as chronically ill and unable to perform two or more daily activities such as bathing, dressing, eating, transferring, toileting, or any cognitive impairment. The other part of the living benefit is a critical illness. It pays you a lump sum benefit should you suffer from a triggering illness such as cancer, heart attack, strokes, Lou Gehrig disease, ALS, blindness, or diabetic, or any other kidney failures, major organ transplant, and more. And the last one is a terminal illness. As you know, as the name says, it's a benefit you get if you're diagnosed with a terminal illness resulting in a life expectancy of less than 12 months, 24 months in some states with some policies. This can be used for experimental medicine, preparation for final expense, or any other purpose you feel necessary. In short, life insurance policies with living benefit could give you a better peace of mind knowing that it is there if you need it, even when you're alive. Now, types of life insurance. There are basically two different types. One is a term life insurance, the first one, and the second one is permanent life insurance. As the name suggests, the difference is like renting versus owning life insurance. In other words, the term is a period, specified period, and it goes away. The other permanent policy is something until you die, or it pays you. Some of them policy, it stays until 120 years old, 99 to 120. Let's look at each of them in detail. Term life insurance. It offers protection for a specified period of time, and that's what the purpose of the insurance is, but it does that. Requires the policyholder to pay only for the protection against death. It does not build any cash value in there. Death benefit is only paid if the insured dies during the set time period. Most can be renewed without additional underwriting, can be less expensive than permanent insurance in the early years when you start with it. But it can be very expensive afterwards when you want to convert it. It can be 5 times what you're paying to premiums, up to the 5 times. Now, this also gives the owner the alternative of investing the savings on their own. Just like in the old days, I think they used to say, you get the term and invest the difference. You know, so in other words, a permanent life insurance, let's say, is $100. This is $60. You get the $40 difference. You invest on your own into whatever you want to do. That's one choice you have. You know, investing the difference. This is typically used by clients interested in covering debts or income replacement in the event of premature death. Term life can be for a specific term ranging from 5 to 30 years. There are not that many for 30 years anymore, but there are some. You may find it. This is typically the last suitable policy for seniors. Now, let's look at the permanent life insurance. It offers protection for life just like the term does. It allows you to accumulate assets in the cash value of the policy. So it builds up some cash for you too as you go along. Can be comprised of 4 main types. Namely, you're going to see whole life, universal life, variable life, and variable universal life. The variable life and variable universal life is more like to do with the, it has more risk than the first two. Each type offers different payment methods, death benefits, investment options, and degree of flexibility. Insurance that meets your need, whole life. It's a guaranteed fixed premium for life. Premium invested in company's general account. Regardless of general account performance, you are guaranteed an interest payment or dividend in this case. The policy has a cash value. There is a death benefit, interest or cash value dependent on general account performance. In other words, like I said, it's a guaranteed, and it's based on how the total general account perform for the company. Interest amount can rise and fall with general account performance. Universal life insurance. Premiums are flexible. Policy continue as long as there is a cash value to cover monthly charges. You earn interest at a rate set by the insurance company. It is generally guaranteed not to drop below a certain level. Choose from 2 death benefit options. A level benefit equal to the policy original face amount, or the increasing benefit equal to the original face amount plus any existing cash values. Variable life insurance makes fixed premium payments, flexibility to invest your premium in one or more underlying portfolio, cash value not guaranteed, high fees, expenses, and charges. Now, the variable universal life insurance. It's a flexibility to invest your premium in one or more underlying portfolio. These portfolios offer various levels of risk and growth. Various options for investment, including fixed rate options. Please note that the death benefits are based on the claims paying ability of the life insurance company. There are some advantages to have those insurance, to have a life insurance. The death benefit that your beneficiary get is income tax free. Premium withdrawal may be tax free depending on your policy. Otherwise, accumulation is tax deferred. Transfers among underlying investment in VL or VUL are not subject to income or capital gain taxes. For non-variable insurance, which is whole life and the other one, universal life, you may withdraw early without the 10% tax penalty that would apply to an early 401k, IRA, or other tax-deferred retirement plans or annuity. Again, based on the type of your policy, there may be a surrender charge. Generally, variable has them. And I don't see anything, the whole life doesn't have it and universal don't have it. Owners. Now let's look at some of the life insurance glossary. Who is an owner? There's an owner, there's an insured, there's beneficiaries. So I'm just going to explain a little bit on this. Owner is when you get life insurance, the policy owner is the individual who has purchased the coverage on the insured life. The beneficiary is a person or people who will receive the death benefit, money that is paid out by the life insurance company when the insured dies. Insured, the policy of a holder of a life insurance policy. If the insured individual dies, death benefit is paid out to designated beneficiary. Now, the beneficiary is the person in the policyholder that the policyholder has designated to receive the insurance benefit. It can be anything, your children, it can be 10 beneficiaries, 5 beneficiaries, doesn't have to be one. You can divide it among your children, have different ratios, your spouse. The premium, of course, as you know, is the payment you make into your insurance policy. The cash value, the cumulative value of your premium payments and the earning of the account minus any front-end sales fees, state premium taxes, insurance cost, and other administrative fees. Now, what is the death benefit? The death benefit is the money your beneficiary will receive when you die. It's the amount of the policy that you took out when you make an application. There's a death benefit that you opted for, and that's what you get generally. General account, the account where whole life premium and other assets of the insurance company are invested. There could be a separate account, the account where the premium or cash value of a variable life or variable universal life policies are invested. So general account would be for whole life and universal life. Separate account would be for variable life. So consider a life insurance policy for more than just a death benefit. You don't have to die to collect on your life insurance. Please die responsibly. No one is promised a tomorrow. And thank you. That's it, folks. Thank you. Any questions you might have? Oh, you can get all kind of policies. Yeah. They can nowadays until about 90, 89 years old. So that you can get almost everything. Depends, like I said, what are you looking for to get out of this? What do you want this policy to do for you?
Basically, just to pay my burial and leave a little money to my son.
Well, there's two different kinds. You can have a term life insurance, which is inexpensive, but you're betting on 20 years as an example. Oh, the better option would be get some term life and convert that. There's a convertible policies in like 10 years down the line, or 5 years, I would say, 3-5 years, when the money situation, into a permanent policy. Because by that time, you're used to paying it, you'll be able to afford it, hopefully, and you'll be able to get Social Security at that point to help you with the income, unless you're taking it now. Medical, and then it becomes expensive. There are guaranteed issues out there which probably accept most of your medical condition. But there are also some companies that will take if you are diabetic or any other, even blood pressure. You had it for a while, they'll take it. It will be a little bit more, but not as bad as the guaranteed issue.
Yeah.
Nothing compared to that.
I don't really want it. It seems that that's all I've been coming out with was a guaranteed issue, but you still have to wait 2 or 3 years.
Yeah.
For it to
because they pay you, some of them pay 25%, 50%, and the third year they pay the whole thing. But with the term and all that, you give me a call and I'll be able to suggest some things, for you. It's just you have in mind how much money you want to spend, every month, what you can afford. You don't want to take out a policy which is very expensive and 6 months down the line you can't afford. Then you wasted your money. So, and then the other thing, also find out amount you want the death benefit to be. Do you want 10,000, 20,000, 100,000, 50,000? What you want this amount to do for you? Like you said, you want to leave it for some kids, right? So let's say funeral expenses 10,000, 12,000 right now. If you have 50,000, you can still leave some money for your grandkids or whatever the reasoning is. So that's what, first, affordability, you have to make sure you can afford. Second, your own plans and goals, see what you like to do. And medical shouldn't be that of a problem unless you have a real bad medical condition. It's your choice, really, the way you put it. In other words, let's say something happens to a person and he has 3 beneficiaries. If you said, okay, 25 goes to 2 of the kids and 50% goes to a spouse, that's what will happen. And they will be paid in a lump sum. Now you don't have to take the lump sum. You can convert that into an annuity. Let's say it was 100,000 originally. 50,000 goes to the wife, 25,000 goes to each. But the kid doesn't want it. He has money. He says, okay, you know what? Take the money, give me an annuity. With the annuity, you can do a lump sum payment at the end of 5 years, 10 years, 15 years, or you can have a monthly income out of that. And the other good thing about that is you can also have one other thing. Let's see, that 25,000, the kid doesn't want it. What he can do is he can take that money and get another policy, a paid-up policy. So there's no more payment. But that 25 will probably convert into a 50,000 or 100,000 down the line. It will just accumulate. Yeah, so he doesn't want the money now. He says, okay, put it in, give me another policy, a paid-up policy that my wife can get or my kids can get when something happens to me. So at that time, it will go up a lot. Especially if they have an issue with the medical condition, because that will give them to putting the money. I appreciate you all coming over and being with us today. We also want to thank the city of Seguin and Seguin Public Library and Mara for having us and being so gracious. Thank you.